Assalamu alaikum and hello everyone. You are watching SaqCh+Partners YouTube channel, and my name is SaqCh+. Today I will talk about year-end tax planning for professionals and small businesses. If you like my channel, please don't forget to subscribe, give thumbs up, and share with your friends and family.
This conference will now be recorded.
Let's get started. This session is coming to you in collaboration with Penn Australia. And our key topic today is tax planning for professionals and small businesses. First thing first, the information that's going to be presented in this session will be very general in nature and does not constitute any tax or financial advice. We tried our level best to give you most up-to-date information. However, this would not be an alternative of a professional tax and financial advice. So you must need to contact your financial advisor or tax advisor for advice on your specific scenario. A quick summary of my profile. I'm a member of Chartered Accountants Australia and New Zealand and a fellow of Chartered Certified Accountants. I have over 15 years of international experience. While I also worked with Ernst & Young Chartered Accountants, which is one of the big four accounting firm. Currently, I'm managing director at SaqCh+Partners. Specialization is primarily the tax and tax advisory and tax planning area for small businesses. Also, we are advising small businesses to improve their cash flow and profitability. We are also providing compliance services, and the data is a big thing in today's business picture. So we do data analysis, and we also provide review services to ensure the integrity of data and just convert that big data into a meaningful reports. So that is the area we are also have expertise in. And I'm also a professional business trainer covering technical topics and data analysis related topics and soft skills, which is very, very important for small businesses. Key objective of today's webinar are very, very clear. The main thing is to help you achieve your short-term and long-term financial goals and objectives. And we receive a lot of messages when we ask all the attendees what are their objectives to attend this webinar. So most of them, they came up with one objective to minimize their taxation legally. And then those savings are going to go towards reducing home loan, saving for holidays, buying a new car, and heaps of other short-term and long-term objectives. So those are the things hopefully we'll cover, and at the end of this session you will be able to achieve those short-term and long-term objectives. And the objective of this session is also to give you a bit of a knowledge around the tax laws and the financial information around the tax laws. And our objective is just similar to your objective. Everyone want to minimize the tax. So here we go. So these are the objectives which you thought and we thought. So we are on the same page. The most important thing in this session would be to differentiate between different type of taxable entities, because that is the key factor when we are calculating the tax, and the bottom line will be impacted by the way you are operating, you or your business is operating in a specific structure. In Australia, you would either be a sole trader, like a person who is doing a business under a personal umbrella or a personal ABN. So you would be a sole trader and running a small business, but business can also be ran under company or trust or partnership structures. So these are the two areas, business models which are being used by small businesses. On the other hand, you can, if you are a full-time worker and working under a TF, and you are being considered as a taxable entity, being an employee of some organization. So every type of structure got its own, pros and cons. Office politics, if you're a full-time employee, you have to pay the office politics. Then you have to, manage try to find a balance between your work and family life. Then if you're working in Sydney CBD or Melbourne CBD or any metropolitan city, traveling is one thing which takes a lot of out of your skin. So that is the key factor. But if you're doing a business, then definitely you are a bit flexible in terms of timing. So that is a bit of flexibility in while you're doing a business, and you're maybe close to your home, and you can set your own working hours. In terms of risk, a bit of redundancy risk is there because of the very uncertain job market these days, and a bit of finance risk when if you're losing a job, maybe your finances would be a bit tight. But if you're a business, initially you may have to face a bit of financial risk, and but later on in the long run, risk is low here in while you're doing a business. But the most important thing is the taxation. If you're working under employment contract, you're a full-time or part-time employee, and you are earning an income of let's say $100,000 gross wages per annum. So on an average, you will pay about 25 grand tax. But if you are in a business structure, either a sole trader or a company, then you will be ended up paying a less amount of tax. And sole trader, a bit less than the full-time job. And in case of a company, it is further less. So, but the conditions are you have to comply with the PSI rules if you are a sole trader, or if you are an individual who is working under a company or trust structure, then you have to comply with the personal services income rules and regulations. Because if you are an individual working in a company or a trust, and you are earning income because of your personal expertise, then these are the rules and regulations that need to be complied with. Otherwise, you will be considered as a full-time employee, regardless you are operating under a sole trader or under a company or a trust structure. So that is a key thing to be considered. So in a nutshell, if you're an employee, 100,000 income, 25 grand tax. Okay, if you're a company or a sole trader, less amount of tax. So that is the key advantage, apart from the other advantages. So this slide gives you a bit of another idea how different entities will be better off as compared to the other type of entities. Companies always considered a better option as compared to the other entities, but again, your personal circumstances will help you to determine which taxable entity is better for you. Any newcomer in Australia, definitely I would suggest them or recommend them go for finding a job. After doing a job for a few years, then you can shift to your business. So that is the better model for any immigrant. Okay, first of all, we will talk about different short-term and long-term strategies for professionals who are a taxable entity, being an individual employee. So first strategy, which is very straightforward, which normally we all focus on that, is to claim all work-related expenses as reduction. So that will reduce your taxable income. And at the end of the day, the tax which we're gonna pay, or which we already been deducted by the employer, and we will reconcile with that, and there might be some refund or we have to pay some extra. So the first thing is to jot down or prepare a list of all your work-related expenses, so that when the time comes to lodge your tax return, which is gonna starting from July, and you should not miss any expenses that can be claimable. It starts from work-related travel expenses to professional education expenses, then some equipments you can use for your work-related activities, or work from home if the employer allows you, donation and charity, then your income protection insurance if you have got one, and last but not the least is any expenses which you're gonna pay to get a tax advice or to prepare your tax return. So the last point, which is tax related expense, most of us try to prepare their tax return, even like the professionals who got a bit of flexibility to minimize their tax, or there are strategies available for them to minimize their tax, but still they don't want to pay $100 or $200 to get a professional advice. So I would suggest them to get an advice so that you can minimize your tax legally. If you're spending, say, for example, just a quick one, $200, and that saves you about your $1,000 or $2,000 tax, I think that expense of 200 is worth spending. Other long-term strategies could be like one thing. These are the first three strategies which we're going to discuss now, are those strategies which can be implemented before 30th June, and that can give you some tax saving. First thing is if you're paying some contribution towards your super fund from your after-tax salary. So you got your salary in your bank account, and from that amount, from your savings, you're paying some amount into your super fund. So that can save you some tax, and because those amount, those contribution would be deducted from your taxable salary at the tax return level. But for that, you need to write a notice of intent using this mentioned form number to your super fund, and that's gonna go before 25th of June, so that they can give you acknowledgement well before 30th of June. Second item is if you're having a good relationship with your spouse, and your spouse is earning a low income, which is 37,000 or less, or if she's not earning any income in this financial year, then you can contribute towards her super fund at a cap of $3,000 contribution, and that will save you $540 of taxation. Same conditions, you have to deposit these funds before 25th of June, so that they're going to be cleared before the end of financial year. I will explain you all these short-term strategies with an example. So if you're not understanding this, just don't worry. We'll cover it up in an example. Third one is if you are a low-income earner and if you're contributing a grant into your super fund, so Australian government is a bit worried about your retirement fund like super fund balance, so that's why they will contribute a 50% of your contribution into your super fund. So that will boost up your super balance. So the thing is, if you are just contributing grant, 500 would be coming into your super fund by the Australian government. All these strategies can be implemented in this financial year. So these are the very, very short-term strategies. So we will cover all these in an example as well. Then there are a couple of other strategies which can be implemented in a next financial year that are going to be your future plan. So one thing is like if your employer allows you, you can do a salary packaging or salary sacrificing arrangement with your employer, and you can buy some of assets like a car or computer or income protection insurance, or you can pay membership of your professional body or a club or gym before from your before tax salary. So that can help you to reduce your taxable salary, and ultimately that will help you to minimize your tax bill. Again, I will explain you in an example. And the next thing is salary sacrificing through concessional contribution to your super fund. So if you're depositing some of your pre-tax salary into your super fund, that would be that will save you some tax. And keep in mind that the limit for this concessional contribution is $25,000 in this financial year. So if and that includes your employer super as well, compulsory super. If your employer is paying 10 grand, and then you have a margin of another 15 grand to top up your super. So in this case, like you can contribute a personal contribution of 10 grand or 14 grand and another grand for co-contribution. So you can mix and mix some different strategies together so that you can achieve the best results. Let's go to example that will explain you how all these strategies are gonna work. Before going to the example, this quick pictorial explanation will explain you how the salary packaging works. If you are not doing any salary packaging, you're paying a lot of tax here. So 2 buckets of tax, and your take home will be much lesser. But if you are doing a salary packaging, then you can doing some spending from your pre-tax salary, so that will save you tax and you're paying a less tax amount, and eventually your take-home pay is higher than if you are not doing any salary packaging. Okay, let's go to the example. Okay, this is an example for Mr. Alex, who is want to do his tax planning for financial year 2019. And in this example, we consider if Mr. Alex is not doing any tax planning, then this will be his position. On a income of $100,000, he would be ended up paying a 25 grand tax, provided we are assuming there are $2,000 of deduction or budgeted expenses which he have already spent from his pocket. So it's 25 grand tax. But if we implement some of our strategies which we just discussed in the previous slide, so that can help you to reduce your tax bill. So the first strategy is personal super contribution. If you are paying some amount into your contribution, into your super fund from your after-tax salary, so that will help you. That would be a deduction. You can claim a deduction for that. I assume 10 grand, okay, deposited into super fund before 25th of June. Notice of intent has been sent to the super fund. Deduction, you can claim a deduction in your tax return, and that will help you to minimize your total tax. And the net savings is $3,800. So this is our first strategy: personal contribution into super fund. It's not bad. It's a 3.5 grand, which means maybe a used car for your son, who's just turned 18. So that is a good saving. And at the same time, your savings, your super balance is going up by 10 grand. Okay, next, number 2 strategy, when you are depositing some of funds into your spouse super fund. So we consider $3,000 you are depositing into wife's super fund, again 25th of June, and so that the funds must be cleared by 30th of June, and this will give you $540 of tax saving. So that by that amount your tax will reduce. So this is a straight offset. It won't give you any deduction here, rather just offset. Next strategies for your next financial year. From 1st of July, you can implement this strategy. Like you can negotiate or discuss a salary packaging arrangement with your employer. And if you're going for a novated lease, I assumed you are paying $500 per month, so 6 grand in a year. So that arrangement will give you a deduction from your tax viewpoint, because that is going to pre-tax. So those expenses would be pre-tax, so that will save you some taxes. And the net impact for that transaction gonna be $2,000 roughly. The third condition, which we did not discuss in this example, because if you are depositing a grand into your super, that ATO will automatically give you $500 in your deposit $500 into your super once you will lodge your tax return. But you need not to mention that 1,000 in your tax. In your tax return, it won't save you any tax. Rather, it will increase your super balance by $500. So last strategy number 5 is salary sacrifice super contribution. I assumed you're paying $50 per week into your super for 52 weeks. So $2,600 that is going into your super. So that will also, given it is a pre-tax, so that will help you to minimize your taxable income. And now your taxable income is $79,400 and taxes $18,400, and this strategy will save you about $900 of tax. And all these strategies, if implemented in a one go, although it's not possible in this financial year, but yes, in the next financial year, so that's going to save you about 7,000 plus taxes. So these are the short-term strategies available for individuals. I can see some questions popping up in the chat box, so we will answer those questions at the end of the session. Now we are going to long-term strategies available for professionals or individuals. Long-term strategy, everyone wants to buy his first home in Australia, so Australian government have allowed you to build, if you don't have any deposit available at the moment, so you can build a deposit through this scheme. And if you are saving 15 grand in your super fund in a year and total 30 grand, that amount can be released to you to buy your first home. So this is a bit of help from Australian authorities that you can build some savings that can be paid towards the first home deposit. There are a bit some terms and condition revolving this saving, so you have to comply with all those terms and condition, and then those funds can be realized. And for this saving, you can only build this one by using your own contributions. Employer contribution, which is 9.5% into your super, that can't be used towards the building this savings for deposit. Next strategy is you can have a negatively geared investment, so that can help you if the overall income is less than the expenses incurred on an investment property. That loss can be adjusted against your other income. Like for example, if your a negatively geared investment is giving you a return of suppose a rental of 15 grand, but the expenses are more, like say 20 grand, so the difference of these two of 5 grand loss, that can be deducted from your other income, and your taxable income will go down, and effectively you will save some tax. So negatively geared investments is also a long-term strategy, but in some cases the loss is quite significant because of the interest, depreciation, repair and maintenance required for the investment property, management fee. So that big amount can save you a lot of tax. Next strategy is you can, as we initially discussed in the short-term strategy, to build your super. So one long-term strategy around the super fund is you can have your own self-managed super fund, and if you can research in the market and find suitable investment opportunities, you can utilize those funds to rapidly grow your retirement funds under a self-managed super fund. So that is one of the long-term strategies available to you. Last but not the least is small businesses. If you are establishing a small business, if you're set up a small business, that is that saves you a lot of tax, and also there is a capital gain tax concession available to you if you're a small business. So in the long run, small business, yeah, that saves you a lot of tax, and also that helps you to make your retirement life very, very comfortable. In a second half of this presentation, we'll talk about the small business related tax plannings, and we won't discuss these first three long-term strategy in detail. That would be covered in another session. So let's go to the business. So residential housing, we'll discuss briefly. Negatively geared properties, we'll discuss briefly. And supers, we'll discuss briefly. Now we do business. In Australia, small business is a business whose sales or turnover is less than 10 million. But if you're working in a bigger structure, couple of entities related to you, like one person is a shareholder in multiple entities. So the affiliated entities where you have a control of those entities, the total sale of all those entities should be less than 10 million. And if you're a small business, you can enjoy a lot of benefits. First benefit is low tax rate, only 27.5% for small businesses, and which is 2.5% less than the bigger businesses. So larger business pay at the rate of 30%, but the small business will pay at the rate of 27.5% on their taxable income. Small business also have some reporting relaxations, which is I mentioned here. So easy BAS and stock take requirement is not there, and a lot of tax reporting relaxation, and also capital gain tax concessions are available to small businesses, so that the owner of the business can have a better retirement life. Now we will talk about some short-term strategies that can help small businesses to maximize their tax savings. A lot of small businesses, they don't want to be compliant businesses, rather they just want to save tax by not reporting accurately their data, which is not recommendable. I would suggest them to be compliant and save tax legally. So here in our session, we will talk about those legal strategies that can help to save your to minimize your taxation. Number one thing for small businesses, which is very, very important, they must seek a comprehensive tax planning advice with a concrete action plan. I mean, how to structure their entity, how to pay to their different associated people, and how to implement the short-term strategies which we discussed for individuals. So all those elements should be put in one paper and then decide what to do or how to minimize the tax. So that is called the comprehensive tax planning advice. And mostly people are very reluctant to get advice because they thought that it won't give them a lot of benefits, but I believe that can help you if you are talking to a experienced and professional accountant. So that can save you a lot of taxes. Second thing is, in a short run, you should pay the super of your employees before 30 June. Instead of paying into next quarter, pay it now, get a reduction. A lot of small businesses, they are paying the employee super with the BAS, business activity statement. But in that case, you can only claim deduction when the super has been paid, which will be next year. So why not to pay it now before 30 June and claim a reduction in this financial year? So that will help you to manage your cash flow and definitely tax savings. Next is you can avail the chance to immediately write off some of your small assets like a car or a printer or some other assets, like a water tank or I mean whatever it could be. So if the amount is less than 30 grand, immediately write off is available to you. Previously, this amount was just $20,000, then it was increased to 25, and now from 1st April 19, this has been increased to $30,000. So $30,000 straight away deduction means roughly 30% tax saving, which is 10 grand. It's a big number for a small business. Next short-term strategy is try to pay some of your expenses in advance, like rent you can pay quarterly in advance, insurance advance, subscription, club membership, etc. Just pay in advance if your cash flow allows, or you have like a credit card a facility which can give you interest free for like a few months. So that can be utilized to pay these expenses and claim deduction in the current financial year. So that's gonna help you to save some of tax in this financial year. And if possible, try to defer income, either postpone the invoices that are going to be issued in the last few weeks of the financial year. But bear in mind, if you have a bit of risk or a customer who won't pay you if you delay the invoice, then don't do that. Just get money. It's better to have one rather to delay it for saving a bit of tax. So yeah, anyway, the deferring income can save you some tax in one financial year. And the last but not the least is bad debts of a business can be written off. But for that, we have to provide that we have followed a particular procedure to follow up from the customers. And, we wrote emails, letters, phone calls, and then if it's still not receivable, then bad debt can be deducted from the income of our business, and that can help you to increase your tax savings. So these are some short-term strategies available for the businesses. Now we will go to some long-term strategies. Oh, before going to that, this says me, this is more important. Tax planning. Get tax planning advice. So normally, the tax planning advice can cost you from like it depends on the complexity of business or business structure. It can cost you between $750 to $2,000. But if that saves you 5 to 10 times of the expenditure, I think that is worth spending money well spent. Long-term strategies, again, tax planning. So you need to seek comprehensive advice for both your short-term and for the long-term. So our company is providing tax planning advice and action plan for both the short-term and long-term to all our customers. Some they are getting it as a part of the package, or some they are asking on a standalone basis. So they are definitely going to get a good saving of the tax. Second long-term strategy could be to distribute dividend from the companies in such a way so that can benefit to the shareholders. So the laws around the dividend is if it is a franked dividend means any tax that has been paid by the company on their taxable income, that would be sitting with the ATO as a franking credit in their franking account. So that money can be utilized to get a franking credit once the company will distribute dividend to its shareholders. So that money can be claimed. So that's gonna be a good strategy for you, especially on those years when your small business is not able to pay you salaries. Then you can utilize this dividend distribution strategy to get some benefits. Next strategy is around the trust structures. In a trust structure, you have to distribute all the income of the trust after deducting the expenses to the beneficiaries. If the number of beneficiaries in your trust structure are a significant number, like 4, 5, 6, then maybe it is easier for you to distribute that to all in such a fashion that can minimize your taxation. But if that is not the case, then you can have a bucket company and transfer some of your operation into that company so that you can pay lesser amount of tax, because company tax rate is fixed. Small company 27.5%, but individual tax is far higher than the company tax rate. The highest bracket for individual is 45%. So that could be helpful for your long-term planning. Small businesses, they also sometimes are having a bit of difficulty to handle the loans, the amounts which has been withdrawn from the company funds, and they are utilizing it in their private purposes. Legally speaking, that money will be a deemed income for you. That is an income for you, and you have to pay tax on that, unless you pay that money back to the company before the end of financial year, or you sign an agreement with the company, which is called Div 7A loan agreement, and you will pay a particular amount of interest on that, which is ranging around 5%. So that is a key area to be complied with, and a small business have to, ADO is also considering that area to be investigated and audited. And other thing is the payroll tax for those small businesses who are having a lot of like a big number of employees and contractors. They have to watch out their limit of $850,000 in salaries. If you pay more than that, then you have to pay tax on your total amount over $850,000 of payroll. So this is a limit that need to be keep in mind, and you have to watch out for this so that you can avoid this extra payroll tax. And finally, land tax is also an area which we need to consider in the long-term strategies, because if you got a property, investment property, or a land on an amount of $692,000, you won't pay any tax, land tax, but afterwards you will pay at the rate of 1.6%. So this threshold is available to individuals and to companies as well. But if there is a property which is under the trust structure, then this threshold is not available, and you have to pay tax right from the beginning, unless you are a special trust which is exempt from land tax. Again, the most important thing is your tax planning. Get it done and ask for professional advice. And with this, so we come to the conclusion of this presentation, and thank you for joining us. We still have some time to take up the questions, and there are a lot of questions in the chat box, so we will try to discuss a few of them. So question number one is, what are the PSI rules for companies? As I mentioned earlier, PSI rules are related to personal service income. Any personal services, like accountant services, personal services. Doctors, they are providing personal services. Solicitors, engineers, so all the IT people, they are providing personal services. So personal services have to follow the personal PSI rules, regardless of their business structure, whether they are sole trader or operating under a company or trust structure, they have to comply with that. So generally, if a company who is a trading company, on that trading company PSI rule won't apply, because they are entertaining or providing services, their goods or services to different entities, different customers. So the PSI rule won't apply on to those companies. But if in a company income is being generated by the intellectual expertise of an individual, then the PSI rule will be applicable on that company. Hope I answered the question. Second question is, will the first home saver scheme savings can be used to minimize the existing home loan? The ATO is very clear on that, you can only save funds from your personal contributions into the super, and that can only be utilized to buy a first home. So if you already have a first home, then bad luck. You can't utilize those funds. Hope I answer your question. Third question is, what are the conditions to make a spouse contribution for tax planning point of view? So law says if your spouse income is coming under the threshold of low income earner, then you can make that contribution and get a benefit of $540. And working condition, whether she's working in this financial year or not, you can contribute. And other conditions are she should have a TFN and a super account to get this benefit. Next question is, what is the best business structure? It is, it's a very, very tricky question. There is no straightforward answer for this question. It all depends on your personal circumstances. If your family structure is quite a big structure, a lot of people in your family having different income structures, maybe in that case a trust structure is better for you. So you can utilize the tax-free threshold for everyone and minimize your tax liability. But if the conditions are not conducive for the trust structure, I mean there are only few adult beneficiaries in the family, then maybe a company structure is better, because in trust structure all the money must be paid to the beneficiaries, so they will pay tax on in their hands. In case of company, you can pay lower amount of tax. So it all depends on your circumstances or your particular scenario to decide which structure is better for you in short run and the long run. Fifth question, and this is the last question as well, how to deal with the income generated using working as an Uber driver. So any income which is generated by the Uber drivers is generally being considered as their business income under their personal ABN, and that income would be clubbed with their salary income if they have any. So, and then the total amount of the income they will pay tax. So, and similar to the taxi drivers, Uber drivers have to lodge their business activity statement every quarter, and they have to, because the income they are generating is GST inclusive, so they have to pay any GST to ATO after deducting all the expenses related to running the Uber operations. So if there is any surplus GST in their hands, they have to pay it to ATO. So hope I answer your question, and thank you very much all for attending this webinar, and hopefully you have gained a lot of tips and techniques and tax information, so that you can save a bit of your taxation. If you have any question, you can call us on these numbers, and we can help you to plan yourself in such a way to minimize your tax liability. You can email us, you can contact us, and once again, thank you very much, Penn Australia, for organizing this webinar, and hopefully this will help you and benefit you, and see you in future. See ya, bye.